Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Well, Eric Brody, I have to say, I'm going to get a little sentimental, my friend. I this has been a ride. I've really enjoyed podcasting. I've enjoyed meeting people. I've enjoyed sharing things. But one of the things I've really kind of gotten to is like, there's a lot of people that I've met and that I have to be nice to for just business sake. And then there's guys that I meet where I really feel like, hey, this is a brother of mine. This is a guy, whether there was nothing else, when I'm in New York, I'm going to have a drink with him, or we're just going to shoot the shit. And maybe it is, we are attracted by the business. I think we're both entrepreneurial that way. There's that hustler. We're both single mentality. By the way, we haven't gone out, there's nothing to that, by the way. We're both single, happily single, by the way. At least I know that's how we talk about it. So I just wanted to start off by saying that. And, one of the things I think that we most connect on is the belief, the paradigm that you just get knocked down, you get up, and you figure out how to clean things up with integrity and move on. And that resilience and strength, perseverance, there's no other way to live.
I think that was great, to reciprocate, it's more like you find kindred spirits sort of in life and that you enjoy because look, you're going to do business. It's going to be stressful. The bombs and bullets are going to fly. And it's like, who are you going to be there with? Those that have been through things. You just seem to, know how they're going to react. And I think it's super important. And I also think what's super unique is you have to be able to learn from people and you know, there has to be differences in what you do in order to look at your space differently. And it was something that I learned when I was punched in the face on that judgment, on that development that I did. But there has to be a complement to it. You can't be a supplement to each other. And I think that where you are and what you do and how you navigate in a space that everyone has sort of like the same business plan and game plan is really quite unique. So obviously, you have to care about each other. You have to like each other. It makes things so much more fun. And in addition, do things that are completely different coming to the same conclusion is really unique and really special and amazing. And it's one of the things I was like, Bill, you and I are cool and we do a bunch of content. We have to do it together. I get a chance to watch your stuff. And I think that there's so many topics that you and I can tap upon. And let's just get into the conversation. And to be clear, those are distress.
Mm-hmm.
Those are debt, structuring deals, which I think that people need to understand, as well as technology. Because those things, right? There's only a few of us out there that are realizing the significance of that change, and even in the mid-market space can embrace it. And you're making that application in the distress, which is like really interesting because getting indicators of potential distress like is fascinating, right? There's so much, and everyone out there today is trying to find this distressed deals, but they don't know that the guy at the center of it, the one who's built his career in understanding that space, is you. And you're my secret weapon. So we better be careful. This better not
Yeah.
go viral.
Yeah, why? It's not. Yeah, we don't want too many likes here, right? You know.
We don't want too many like and follows, you know? So do
Well,
you
one.
mind if I ask you some questions that I think the audience would really want to know?
Sure, absolutely, go for it.
Okay, so everyone today in the last 20 years, things are bright and shiny. And I know you're going to tell me, well, in my corner of the universe, but now it's getting hot, so it's in the center. But let's talk about sort of mine. Every developer, builder, he took the money, rates went down. Even if he was late, he was okay, right?
Right.
And then all of a sudden, things aren't going great. Okay. So the first thing is there's this universe. So tell us just briefly there's this universe when all of a sudden your lender isn't really there anymore. It goes over here to these people, and there's a whole universe there.
The special
So what
servicer.
the special servicer? So just like tell me a bit from the lead from no from your like lender side. Like what is that? Like how did you get into that? What the hell did you even decide, you know?
Right. I mean, well, I got into dealing with distress loans 17 years ago, right at the time that distressed loan numbers were through the roof. 2008, literally 3 months before the fall of Lehman Brothers, there were thousands of mortgages going into foreclosure, people walking away. And so there was always a distressed loan world. And prior to 2008, a lot of that world was inside the banks. Banks had their own special servicing departments. They called them special asset groups. And then their collections teams, a lot of the banks serviced their own loans, and they would have specialty teams that would work on the loans that were stop paying or spotty payers or whatnot. When 2008 happened, the first thing the banks did was distance themselves from all of the servicing. And so special servicers popped up, and there was so much product of distressed loans that it was an opportunity to get involved in with up and coming new servicers to the space. There's always been special servicers on the CMBS level, on the larger scale loan level. And there's always been large mortgage servicers that call themselves special servicers because they make their money more so off of higher rates they can charge for dealing with the loans that are in foreclosure or about to go into foreclosure.
So it's interesting because I always talk about it. You have to have a career making money with revenue, and then you can invest, right? So for you, what was fascinating is you're like, yeah, I'm an asset manager in the special servicing space, right? And
That's
we'll
right.
get into like, what that means, and I'll tell from my perspective. And then you're like, I now have a fund that we now invest into deals that make sense to special service, to turn around, to right size the real estate, which is everyone out there raising
That's
funds
right.
for. So the first one, special servicing, is like, well, it's happened to me now a plethora of times. I am now an expert in special servicing as a borrower. So the first one is like, the first one is, you go to refi and the proceeds aren't there. So you're late a day. Immediately filed a special service, and you don't know what that means. A partner of ours on a deal did something that they defaulted personally on something. It goes to special servicing, right? So
Right.
what is special servicing?
Okay.
So I get it. What does it even mean?
Sure, sure. Well, it is a highly specialized trade because special servicing is a segue to enforcement and or aggressive collection of the debt. Prior to that, a regular servicer is really basically a glorified accounting firm. They take in the money, they make sure it gets sent out to the right people, the escrows are good, they keep the accurate figures. That's it. It's special servicing is everything else beyond that, which starts with worrying about the property itself, having regular inspections to the property. Once a loan goes into special servicing, the risk of that loan going into foreclosure obviously increases dramatically. Now, a good special servicer will, in the first 90 to 120 days, by which a loan starts to default or hits a default, will step in, Work with a borrower, be proactive rather than force enforcement. They will listen to what's going on and they will look for solutions to get that loan reperforming as quickly as possible, even if it's under some new terms or whatever, because a performing loan is always worth more than a non-performing loan. I will divert for a second because there is a world of special servicers that is not necessarily their agenda, because they might be hired by investors whose agenda may not be that of a legitimate bank just looking to get a clipped return and preserve their capital. There's a whole nother world of private capital out there, especially now more so than ever in the commercial space, where you've got private equity lending money at with the potential to make a lot more when you as a borrower default. That's a whole nother conversation. I don't know if you want to go into that.
Let's break it down. So you work like differently than what people don't understand. If you work and you say investor, that's because when you get under the kimono on the debt side, so now for the borrower, I mean for the lender, many of them are the emperor wears no pants. They have investors, they are syndicators of debt, or it doesn't matter. They are responsible. It's the lender's money. So the lender is now saying, we have a problem. Borrower isn't there anymore. In-house, we're not going to have these teams of guys. We need these specialists. And that's a special servicer, right? And you said two things.
Right,
One is either loan to own, and now they're looking to aggressively take it over, or they're looking to get it back into performing status because the value is there, right? So,
right.
boom. Now, there was something you said, and I thought it was fascinating on like the tech space to it. So imagine you got your reps in '08 in the RMBS market. By the way, like my most successful friend and amazing human is the biggest bankruptcy and workout attorney. And I was telling you, he was getting all his reps in the fix and flip. So the laws are there, right? So the first thing is, and you once said it to me, you're like, we're using tech now because we've done it so much. We now have odds up to which way something is going to go based on borrower behavior. So what are the different ways? And I was thinking about this the other day, like even it doesn't matter if it's $1 billion deal or $100 million deal or a $10,000 deal. What are the like 7 or 8 categories of where these things go? And it's like, which bucket are
Mm,
you in?
for sure. Absolutely. Um, so there is a bucket of borrower that runs on hard times, you know, freak situation, loses a tenant in a property, major tenant, has damage to a property that, causes a restriction in rent flow, just needs a period of time to work things out. And that is, let's forbear, let's give them a modification, let's work with them, let's stay in communication. Great. Then there is,
Wait, let's break that down though. So that's like you have a business plan, something occurred, and you're on it, right? It's not
mhm,
what happened in the past, which is like I just ran out of dough. This is like
right.
so that's one bucket. One bucket is like, yeah, this happened. I'm on it, right? You're watching it. You got to get a fee for. I look, I got to pay attention. It's my job, but like, do your thing. Let me know. So you forbear, which is really an amendment to the agreement. Like, we're not going to come after you. We'll give you some time to handle it. So one is like, you're good. You're like, yeah, I'm sorry I even have to communicate with you. It's happenstance. I'm on it, right? That's a
hmm
percentage. Got it.
hmm Then there's a group where, they got probably more loan than they should have to begin with. The DSCR was a little tight to begin with. They realize that they do, but they're going to continue to struggle to make this deal work. Even when interest rates have now changed, doubled in the last 3 years. And they know that when it comes time to actually refinance this loan, they are, probably going to have a loan to value or debt service coverage issue, because all commercial loans end up having to mature in the 5 to 7 year time frame, even if they're under a 30-year amort. We know that. So there's a group out there that is extending and pretending. They may be spotty payers. They may be still paying. They may, they're cagey. They're not really communicating. That they're talking to their loan servicer. They're making payments when they have to. They are hoping to gosh that interest rates are going to somehow miraculously go back down to 3%, so that somewhere down the road they think they could maybe get this property refinanced again and keep it and hold it together. So that is the kick the can down the road. By the way, a majority of people that are struggling in the commercial sector or in the debt service coverage residential sector are those people. And who falls into that category? Airbnb, all the short-term rental people in the resi space that have, these loans that are short-term loans, or they're higher interest loans and potentially going higher. Then there's a third category of borrower that is really knew what they were doing, and got themselves basically a cash out in the last couple of years. And at this point, they've cashed out on the equity at 80% when the market was at its lowest cap 3 years
Mm-hmm.
ago, which basically means that they're about 100 LTV today. They know it. They've stopped paying. They're not answering the phone. By the way, they're still collecting rent. And, this could be a commercial apartment building, and they know they've cashed out. So now if they're in a judicial state, they can really have some fun with this, especially if their lender's big and dumb enough and new enough to the industry that they're not gonna that maybe they could string them along by answering the phone once every 6 months and saying, "Oh, I'm gonna get you caught up," and so that strings along a foreclosure. And now on top of having cashed out, this borrower is no intention of ever paying. Lender's already paying the tax and insurance. They're kind of getting strung along. They have to start an enforcement action, but in some states that could take a while. Even in the commercial
Now,
space, that could take a few
what
years.
does a judicial state versus a non-judicial state mean?
Great question. Judicial and non-judicial is about 50-50 in this country. There's non-judicial state means that you can take administrative actions through a state or local agency in order to effectuate the foreclosure of the property without going through a state or federal court to get title to the property. And by doing that, in which a majority, like just over a majority of states, and you can guess that those are the states that are mostly like middle of the country, more conservative states. Texas is is a non-judicial foreclosure state, meaning there's not a lot of argument you can make as a debtor to prevent someone from foreclosing on the property. California, believe it or not, is a non-judicial state, although they have added in some measures that have allowed folks to make it feel more judicial than non-judicial in recent years.
So
Uh,
when you're non-judicial, sort of as a investor into debt, slightly better. It can get to it faster if you got to take
right.
it over.
Less
Judicial is
concern that
all
you're going to
this,
get strung along for two
right?
years carrying the taxes and property insurance and maintenance on the property while some other guy's collecting rent or has possession or is living in your property.
So let's talk about the fun stuff that everyone wants to hear. The two things I want to hear from your perspective. So what's your macro thesis today? Either as a special servicer, investor, like what do you think? Where is this shit box going? And then the question is, what are you doing to capitalize on it? And then
Yeah.
we could talk about like what you and I do together. But like, what's your macro thesis on what's popping? If you're like
Yeah.
you're either a lender or you're like, I'm starting a new fund, like where's the opportunity and like what do you think is happening right now?
Well, for my personal point of view, my favorite thing to look at from a macroeconomic perspective is large societal paradigm shifts. Stuff like that fascinates me. And large paradigm shifts are where opportunities either exist now and only certain people see it, or a huge opportunity set will open up once the dam opens up, so to speak. And where does a paradigm shift happen? It's when fallacies are broken. When I say fallacy, I'm thinking where a society the society has fallacy thinking throughout the years. There was the idea that a woman's place was in the home. Up until 50 years ago was the society's thinking, and that's obviously a fallacy, right? Um, it's a fallacy to think that money should have been free to begin with. We should have had a zero interest rate policy to begin with. It's a fallacy to think that interest rates are going to go back anywhere near where they were just 3 years ago and in the 10 years preceding. I mean, we are maybe at a normal place now, but there are other factors in place that could drive interest rates in another direction, even beyond one person or one group at the Fed making decisions to lower that. We know that's so the my macro thinking is that we are on the cusp of some major changes in the way people live. I think it's a fallacy to believe that you can just ride the stock market and sit at home and play video games your entire life, and that's a career. It's a fallacy to believe that you don't have to work hard to earn something, and that's unfortunately an American problem, I think, that we need to break out of. I think a lot of the rest of the world already understands what it means to get up and work, and for their living. It is also it is a fallacy to think that this is just going to keep going up and up and up, and that people can afford to live under these circumstances.
So now what? You're saying you believe that interest rates will either stay flat or go up, and that this pretend and extend is a rap ski pot pie, and there'll be, and
You've got
so
okay,
is that
a
true? I don't want to
couple
answer
of
that for
areas
you.
to
Is
look.
that true? I don't want to answer. You're like, yep, that's what's gonna happen. You're like,
That's
wait, what?
over. It's over. Let's on the commercial side, we already know there's a $1 trillion maturity wall. There's a lot of private equity out there offering takeouts. It doesn't necessarily have to hit like a slam of bricks, but that's a huge amount of debt that has to be refinanced in the next 12 months from low interest rate mortgage rates before, when they were originated 5 to 7 years ago, to a normalized interest rate today. And a lot of that debt is going to have trouble refinancing. Either it's going to get priced and sold at a discount, or something else will have to be done there. On the
Wait, let's just pause for a second. That means that you paid $100 for this asset, you took out $60 in debt. $40, peace, your equity gone. You're saying now the lender either takes back whatever proceeding it is, that they're going to have to sell the 60 cents at a discount because the rate on the new loan is going to be greater. So we're talking about massive discounts.
It could go both ways, and it could go one way. I mean, this is going to be a great, interesting battle between private equity and private debt over the next couple of months and years. And in some cases, you've got firms playing both sides of that equation on different deals or on the same deal. I know for a fact many LPs who've had their entire equity wiped out in multifamily transactions. Getting letters that say, by the way, we are 98% occupied. We built the community we promised we would build for you. Everything has gone as planned except for interest rates. And that interest rate shift alone on the construction loan to build this property, combined with the additional costs and a little bit less NOI than we predicted, has wiped away all of your equity in this deal. And I know millions of people that are getting those letters now. Well, I don't know about millions, hundreds of thousands of LPs around America that are dealing with that. The other interesting thing about
But you mean
commercial,
LP on the equity side. You don't mean
yes,
LP on the note side. So this is
that's correct. That's on
LP
the
on the
equity side.
equity.
Yeah, on the equity side.
Hmm.
Now, where the lender may have to take a discount is if I'm a lender at 60 LTV and I think I'm still protected, but I know I got to go out and foreclose on this building in downtown Chicago. I'm going to spend more money maybe the property will be worth another 10% less a year from now by the time I'm ready to really sell it. So I could actually end up still losing money below my 60 or having to spend more to get that original 60 back. So the net present value of a non-performing loan, even at 60 or 70 or 80 LTV, is never 100%. For many years it was in the world of secondary because free money would come in and take it out, and it was all just an arbitrage game. It was just, the usual private equity game. Well, that jig is up. And
Well,
so
what's
that
interesting about
money.
what you said to translate is yes, it's worth 100 cents of the 60 cents of the debt, but the NPV, so the timeline it's going to take for you to get to the asset, the cost of carry, maybe the cost of increased construction, inherently means it's not because it's at the end result that the value is there. But this timeline to getting there, that means in this moment it's worth less. So it's almost as if there's a development cost to a lender. You have to pay lawyers, you got to pay special servicers, you have to carry it. So there's a sources and uses also for the lender and a timeline that they have to underwrite and maybe take a discount today, even though they're saying it's worth 100 cents. Yeah, in this future moment.
Correct. And so it's a matter of whether or not you can wait it out, right? And that's why we are starting to see a shift, a sea shift in banks' philosophies about selling, in private equity's willingness to maybe scoot some stuff out the back door at steep discounts because they see that this could be a snowball that's just waiting to come down the hill. And we're seeing a turn in certain real estate markets as a result of it. In tandem with that, residential buyers have finally said enough. There are certain classes, certain areas, which I would call green and growing, northern Florida, the deep south, areas that everyone flocked to pre-COVID, and then in the years after COVID, I think the demographics are starting to realize that that's also not necessarily a long-term trend. Trends change, demographics change, and what goes up has to come down. We need to see a normalization of real estate values across the board, as well as other asset classes. I can only speak for debt and real estate, but I think art's too expensive too. um, but
No, I hear
but
you.
we need to see a normalization of prices. It will strengthen the US dollar in the long run. It'll make more people be able to open up their wallets again, because right now everybody's shutting it down. Everyone's shutting it down because their credit cards are bills are getting higher, the interest rate on those credit cards are higher, the number of hours you're getting at work are down, the cost of everything is higher. And I think we're finally turning a point where uh, we need a reckoning, and this will be good for the economy. It'll be good for us long term.
Well, that's what's interesting. So when you and I discuss, and where people are like, well, how are these two sort of random people, besides that they have this emotional and spiritual connection, the total development cost that we spoke about before, when it comes to like construction and development, me and you come in because that's a skill set, that's a compliment for the two of us. And we're seeing those opportunities. That's how we met. We met on a development that I'm completing, to remain nameless of everyone. We're developing something together that we're doing special servicing, asset management, and development is now considered asset management. Riddle me this. I agree with you on all of it, and you and I are sort of under the kimono. We've spent
Yeah.
our time, and people are communicating us with honesty, and obviously we have incredible discretion, and they're interested in communicating with us. Tell me why there's such a cultural freaking problem with people stating on the lender side, on the investor lender side, on the total lender side, credit funds, that they can't communicate with honesty. That and I know you said it best before. You're like probably gave you too much debt. Fine. why won't they communicate yet and sort of open up to the market? It's all this underhanded backdoor, especially there's no efficiency right now in that marketplace. Is it
Correct.
inefficient when it comes to, yo, we got stressed, which is why me and you are so popular, which is great. Like it's great for us, but what is the cultural problem? What are you seeing out there?
It is a fear of a broad scope of repricing around the market. There is so much concern that one big shoe drops or enough people come to market with what's actually under the kimono. And you and I only see little bits of it, and it's crazy what we see. I know I hear even further. I've seen stuff that you wouldn't believe. $100 million investments that have been written to zero. And I think that the market in general is in cahoots with white knuckling it of out of a fear of a broad repricing of all assets in the market. Does that make
And you know,
sense?
it's interesting. It does look from the real estate side, okay? The principal real estate side, you can be a lot more honest. People really appreciate it, call the lens of reality, and they'll say it, especially on multifamily anywhere, just with, the way in which legislation changed, the way in which like we can talk about it. There's a problem. The yield isn't there. Interest rates rose. We're rocked. We are equities wiped out. On the debt side, I still go to conference and speak to them. No, no, everything we did was great. They're not telling you they're selling 90% of their portfolio, and it's like they still have this ego issue that it's perfect. But your explanation maybe is true. And it's that when does it drop that everyone goes, oh shit, all of our paper is no bueno and it's not
Right.
good and we have an issue. And it's the same people in the market today, like you're saying, trying to double down and buying distress who probably have distress. I just don't see how and they're always like, no, no, but our deals, you're like, this whole neighborhood's toast. Not yes, the whole neighborhood's toast,
Except
but us.
ours.
And you're like,
Yeah.
wow, that's
That
really interesting that for some reason you did something greater than
right.
everyone else at all times.
What you're touching on there is also part of that lemming effect of all of this private equity capital in the lending space, this non-regulated lending that's gone on, especially and bank and regulated lending. Banks have played investors in a lot of this private credit. And they all think their shit don't stink. And the reality is that they were all just valuing or chasing the same low yield BS deals that they should not have been involved in. And um that is another second aspect to answer your question that I think plays a role, which is um I've never on the front end, all of these private credit originators have popped up, a lot of them in the tech space. The reality is they don't know how to collect a debt. And, in my opinion, you should not be lending money if you don't know how to enforce that debt. They know how to create algorithms or create pretty pictures on the computer that rationalize why this debt is a little bit better credit because of whatever failsafe their technology brings into it. But these are not lenders by trade. They're based on assumptions of free capital that do not exist anymore. And I think all of them are out pitching how brilliant they are and they have zero defaults. When in reality, the private lending space was always meant to have a higher default rate than banks. It was the whole point was, oh, you get a little bit more yield being a private lender because you're willing to deal with an 8 to 10% default rate where the banks are only willing to do a 3 to 5%. That's the credit quality difference, right?
But
Okay, but
doesn't that then push them out of like they've got to take risk on the deal? Meaning, if they are so conservative, their algos, they'll never get a deal done. So isn't there this like
that's right.
eventually they're like, you got to take the risk, and they just boop, and you're like, you got to stay super disciplined, even though you'll never get a dollar out the door.
Well, that's the difference. And I think at the end of the day, you'll look back on this era, just like you look back on this is real estate's version of the Noni mortgage to retail consumers. It's all in the private credit space, and it's both in single family rental, DSCR, non-QM, and more so in commercial. I did not realize what a large percentage of small balance commercial mortgage properties are owned by single member LLCs and individuals. This is not institutional players. It's not even family offices. This is doctors that rent an 8 unit office building, medical office building. They're the main tenant. They've got other doctors as tenants. These are police officers and firemen who graduated from single family rentals to a 12 unit mid-rise apartment complex. They have a 7-year-old mortgage that has to be refinanced, and they can't get the rates to fit, and they can't find refinance, so they go to the private market. Now they're dealing with private equity lenders. This market was ripe to take advantage of. It's ripe to be dealt with. It's a ripe to have good players like us come in and help these borrowers when we can. But the reality is all these originators out here, these tech originators, these guys that, this is their business, they had to take risk. Just like the mortgage guys had to take risk on the securities back in the early aughts, these guys on the private lending space have been doing the same thing. I've seen it because I've
By the
seen
way,
meltdowns.
I agree. I mean, I agree with you, right? But I think and even the super professional, the super duper smart people that you and I, when they talk about why they decided to do something, like always with these big ideas, and they're going to be right. I also, we're still seeing people giving back multifamily. Those guys were a lot smarter than us in New York, right? And they
Oh
gave
yeah.
back BlackStone or BlackRock, giving up the
Oh yeah.
portfolio. Like, I'm even going to say that even the super smart, right? Just the
Oh yeah.
incredible guys are still wrong also on their
Abs.
stuff, because it still happened to them too, meaning it's going to
Abs.
be in that space too.
100%. Well, Brody, listen. How old is your average Blackstone managing director?
40.
33?
Okay.
I mean, that means in 2008 they were in high school or middle school,
Yeah.
I mean, they don't know what it's like to have to spend money. The cost of capital has been on the decline or zero for the bulk of these people's lives. The models just don't make sense when zero capital is zero cost. And you're 100% right that even the smartest guys in the room, I think, and I think that, if anything, is where the black swan event will come from. It's when not a Blackstone, but a Carlyle Group or some other well-respected, high-end or large or mid-level private equity firm goes belly up, and no one saw that coming. And that the only way that's going to happen, by the way, is because they're over leveraged, because it all comes back to debt at the end of the day and the cost of capital. And, things are just getting repriced for that point.
All right, the last thing, because we know no one would listen this long. Give me a crystal ball. You and I are getting busier. We're seeing more opportunities. These are all sort of like, it's not quantitative stuff. You and I are qualitative in that regard. We're tasting it, we're feeling it. Our skin is
Right.
going, "Boop-de-doop." There's more stuff you and I are looking at. We're trying to figure out. We're trying to raise capital around this, and we know how to underwrite, and we know how to get to the asset, and we know how to make it happen. But it's like, and we're tingling. When do you think these events occur? Is it and by the way, you and I know we're wrong, so we're just throwing this out
Right.
there anyway. Is it 3 months, 6 months where you see this happening? Is it a year? Is it 2 years? Does it never happen? What's your take on it?
A liquidity crisis will have to occur because of a large move in some market, some asset class. The most obvious one that everyone seems to agree is way overvalued or and kind of way misaligned, where you've got the top, whatever, 20 stocks being 80% of the growth, is in the stock market. Traditionally, the fall months of September and October have been known to be the months where corrections will happen when they happen. If you look at it historically, going back to September and October's, are the months to keep an eye on. So if there's a year, I would say better. I'd be willing to bet better than 50-50 that we would see some stock market interesting thing happen. That would be this September, October. I also think that the risk of geopolitical plays a big role. I do know that as of today, here in the middle of the summer, Adam Services, which is one of the biggest residential real estate tracker of values, has finally come out with 6 full months of data to support declines in values in certain in the majority of residential counties around America, and a huge jump summer over summer this year from compared to last year in the number of foreclosure starts in residential. They just announced actually this morning, like a 13% jump year over year, last year to this year. So we are seeing stuff happen there. My guess is, I mean, I also believe that you've got a man that's got Teflon on him for some reason in the White House. So he'll figure out a way to maybe kick the can. Governments are been the biggest wild card, no matter who's in power, especially here in America for the last 20 years. I think the biggest wild card is how can federal and state governments put their fingers on the wheel? And if the shit does hit the fan anytime soon, maybe if we have a Strait of Hormuz thing and all of a sudden oil becomes too expensive coming into the winter, whatever it might be, don't count out good old boys in the Senate and Congress and gals from coming in and even that with the Republican control, we unfortunately in this country have a habit of capitalizing gains and profits out to private individuals, and then having us, the taxpayer, pick up major losses too. So that's like who knows what the wild card is there. But my bold
No,
and big
agreed.
prediction is this is the year, bro.
All right, let's go. So I wanted to like in closing, there's two things. So when I get into trouble, you are my rabbi of understanding. I wish I would have known you years ago, but unless I got into distress, I wouldn't. And now that I do, it's like I have a team that if anyone ever came after me would be just grade A, from bankruptcy workout counsel to having my own special servicers on my side. And now and then you're coming to me on sort of this development and then
That's right.
capital raise and restructuring. So hopefully we're one of the teams that really do some incredible stuff,
You
and
you
I'm
and I are
really
going to be
excited
doing a
for it.
lot of business together. I mean, it says a lot about a man who's unafraid to um, learn and grow and come out and share his story with people, and then want to be a sponge for other people's stories in such a way that it really does pay it forward and in turn pays it back, right? And so I acknowledge you for that, and let's go do some more deals. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.